Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of March. March for the stock market tends to be a positive month overall on average for the long term. It's not one of the best months. It's not one of the worst months. It still is in that favorable 6-month seasonal period for the stock market from late October into early May. And most of the gains on average tend to be made in the first half of the month, something to watch out for. Let's jump right in and take a look at the action on a seasonal basis for the month of March. I'm going to use the Thackeray's 2022 Investors Guide here, and let me flip through to March, the beginning of March here, and walk you through this here. So here's March, and this is the average from 1950 to 2021. You can see on average, it tends to have its biggest increase at the beginning of the month, the first half of the month, and tends to flatten out in the second half of the month. Now, this graph down here shows the daily probability of, or frequency, I should say, of positive performance. Above this line, a positive line means above 50% on the trading days are positive, and when it goes to below this line, it means it's below 50% positive. And you can see that most of the first half of the month tend to be positive days over the long term. And on the second half of the month, on average, the trading days tend to be a bit mixed and perhaps a little bit negative on a frequency basis overall. And if we take a look at the sector performance here, so the top performing sector from 1990 to 2021 was the consumer discretionary sector, and it's produced an average gain of 1.6%. So this column's ranked by average gain here, and we have the frequency of outperforming the S&P 500. And this is a fairly solid number for the consumer discretionary number, outperforming the S&P 500 69% of the time. Second in line comes the material sector at 47%, the industrial sector at 59%. Utilities, it seems like a little bit of a misfit here, that utilities tends to do so well in the month of March. Something to watch out for, actually. And then we've got energy, which it's one of the better months for energy as far as on average over the long term. And from 1990, it's produced a 1.1% gain, and 56% of the time it's outperformed the S&P 500. We've seen the energy sector on fire recently, and April is by far the best month of the year for the energy sector. So if we can continue to see that momentum, that would be positive. Telecom, financials, and consumer staples, information technology. Look how low information technology is here. It's produced a 0.7 average gain, and it's only outperformed the S&P 500 44% of the time. And then you've got healthcare, which is generally considered a defensive sector, only outperforming the S&P 500 31% of the time, which is not a lot. Let's take a look and see where these sectors rank right now and how they've been performing recently. Before we get into that, though, I do want to take a quick look at the S&P 500 and where we stand right now on a technical basis here. So if we take a look at this graph right here, this is the S&P 500. I just want to point out a couple critical lines here. Here we are at the end of the year, drawing, having a little peak here, and then we saw that movement back down from that level. I want to draw a line here across at 4,300, and you can see here, if I draw that line going all the way across, that really is a head and shoulders pattern. Here's the left shoulder, this is the head, and then you get the right shoulder here, and this is the neckline at 4,300. We did dip below that line. You can see here at the filming of this video, we're above that line again. If we go below this line again, that could spell trouble for the market if it stays down there for more than a few days. It didn't do that. We didn't see that large volume capitulation take place for a negative condition for the market to continue lower. If we take a look here, I also do want to point out that we do have this trend line here of channel developing here. We need to see the S&P 500 break higher above this channel to show some positive support. And we've seen with the Russia-Ukraine war that's taking place right now, on an intraday basis, the market's moving up and down all over the place, but we do need to see a fairly consistent pattern. A few days above that trend line would actually be positive for the overall markets. I want to show you this graph here for the S&P 500 here for the let me just go here. This is, in this case, what we're drawing is the growth sectors of the market, the relative performance compared to the S&P 500. So this top panel is the S&P 500, and this panel down here represents the growth sector. So we've got XLY, which is consumer discretionary, XLC, which is telecommunication or communication services, and we've got XLK, which is technology here. I want to point out a couple things. Here's 2020, and look at, first of all, let's look at communication services. That sector has just been a horrible underperformer relative to the S&P 500. And that's happened since in 2021. Actually, it goes back into September here, and we've just seen that strong underperformance. The technology sector, which is in green here, we saw in December start to pull back down here. It's been underperforming. I do want to point out, let me just erase that for a second. I do want to point out that here's the month of February. We saw the technology sector underperforming the S&P 500. It continued its underperformance. And initially, this bottom panel represents the yield on the 10-year Treasury note. The yield on the 10-year Treasury note was increasing, which puts pressure on the technology sector. But even when we've seen the yield decreasing, the technology sector has continued to underperform. Now, we're out of the strong seasonal period for the technology sector as well, but it's just continuing to underperform at this point. And in this case, the blue line here is the consumer discretionary sector here. And you can see this consumer discretionary sector in February underperformed the S&P 500. Now, it's been a fairly consistent underperform here. It did that in January as well. It did that in December. So we've seen some underperformance for this sector overall, but this tends to be the stronger one of the strongest sector on average since 1990. So we could see a little bit of an uptick here on this. There's a lot of stuff happening in the markets right now, but that's the one to watch out for in the growth sectors would be the consumer discretionary sector. A lot depends on what happens with Tesla and Amazon, just because they make up so much of that sector as well. If we take a look at what's happening as far as, in this case, the defensive sectors, I want to point out one thing here, and that is that, let's take a look here. Let's go back to 2020. Let's go to December. And so these are all the defensive sectors relative to the S&P 500. If you take a look at this group here, look at these lines. I'll define them in a minute. They're all heading higher. This was at the time, this is the S&P 500. The S&P 500 was heading higher. And on top of that, the yield on the 10-year Treasury note was heading higher. This was an unusual combination. So to see the stock market going higher and to see the yield on the 10-year Treasury note going higher and the defensive sectors all outperforming the S&P 500, that showed us at the time that investors were getting really concerned about the market, the valuations, but they still wanted to be in the market. And sure enough, what we saw in January is we did see that downturn. Now, what's interesting is the defensive sectors in general as a group don't outperform at this time of the year, but we saw that again in February. Overall, we saw a strong performance in February and in January, I should say. And even in February, well, the green sector here, consumer staples, look at consumer staples here. It's been a strong performer. We did see the other sectors up and down here. Overall, they have been outperforming the market though. Okay, so once again, the defensive sectors are performing. This should not be happening at this time of the year. That's just showing that investors are really quite concerned, just like back in December. This not quite to the same level, mind you. And I do want to point out here that the consumer staple sector, we did see that strong run here as the market, the S&P 500 pulled lower. When the S&P 500 bounced, we saw that pullback. But we have seen strong outperformance even when the yield on the 10-year Treasury note was moving higher. So the defensive sectors are actually holding up here. When they're holding up at this time of the year, that's an indication that the stock market is not set for large gains. We're not going to see, probably not going to see a strong rally that's going to have a sustained hundreds of points for the S&P 500 at this point. That's not what happens when you see the defensive sectors outperforming. If we saw the growth sectors and cyclical sectors outperforming and we saw the defensives underperforming, that's what you want to see for a strong continued rally that's multi-hundred point rally for the S&P 500. That's not what we have now. So we may see the S&P 500 move higher, but right now we're not set up for a strong rally on this. I also want to take a look at the cyclical sectors for the S&P 500, within the S&P 500. If you take a look here, this green line here represents the energy sector. Look at this from the beginning of the year. Wow, on fire. January, You tend to see some volatility, but that sector just continued up higher. Even as the S&P 500 was moving down, we saw the relative performance continue higher on this. And recently we've seen the Russia-Ukraine conflict building the war premium into the price of oil, which is helping the energy sector as well. But look at some of the other ones here. The gold sector, this is the financials. We saw the financial sectors as the yield on the 10-year Treasury moved higher. We saw it move higher. And when the yield moved lower, we've seen it move lower. And that's typical for the U.S. financials. It's more, the sector's more interest rate sensitive than the Canadian banking sector as well. If we take a look at the red sector here, so that's the material sector, we've actually saw the material sector outperform. So all of these sectors outperformed in the month of February, outperformed the S&P 500, but not by a lot, except for the energy sector, of course. And then we saw the materials outperform here. And also, too, in this case, we did see the industrials outperform as well a little bit here. Even as interest rates moved higher and then lower, we've seen a fairly steady performance for the industrial sector overall. So where are we right now for the month of March? The stock market showing a very defensive posturing. It doesn't mean it's going to correct. We've seen the energy sector being the anomaly. We've seen investors rushing into the energy sector, and it tends to be strong on a seasonal basis from late February into early May. And just because it's been strong in January and February does not mean that the sector itself will start to pull back just because it's had two strong months. It can continue. And that's particularly true with the commodities sectors. They can continue to perform well. So we may see that if there is some sort of ceasefire resolution in a war, we just don't know what can happen. It's really a binary situation in the Russia-Ukraine war. It looks like Putin's backed into a corner at this point. Maybe he leaves Ukraine and grabs a bit more land on the way out and to try and save face. That's a possibility, of course. But on the other hand, he might just escalate the situation. And right now, the West and the Allies are saying, well, we have it under control with sanctions, but I'm not sure that that's totally the case. The tail risk really here is that Putin actually starts to really escalate this. And that's not really being factored into the market at this point. And we're seeing some wild swings in the market, but we can see, some sort of resolution as well that could move the market. But in the month of March right now, we're seeing investors take this defensive position. And that we saw this before the Russia-Ukraine situation. This is just on top of this. Here we are heading into the rate hike cycle starting for the Federal Reserve, probably on March the 16th, whether it's 25 basis points or 50 basis points. And I think that's independent of what's happening with Russia and Ukraine as well. Maybe they're a little more dovish in their talking, but I think they sort of have to, for their own credibility. They've lost a lot of credibility with having far too easy of a monetary policy for far too long. They have to actually start to step up here and fight inflation here a little bit. So investors are just getting scared with that. They're not sure exactly what the impact is going to be. There's reading that, it's not really going to matter. It's only 25 basis points, but it's really the next hike and the next hike after that and the next hike after that. And on the margin, when you're coming from, let's say 25 basis points and you're doubling, that's a huge amount of money. That could be transferred. Let's say if a small business has that small loan, and you see a few rate hikes, that means their interest rate payments are going to double perhaps. So this is really going to have an impact on the economy down the road. It'll take a little while for it to take place. But right now, I'd be watching the defensive sectors of the market. They tend not to, other than utilities in the month of March, they tend not to be the stronger performing sectors. But if they continue to outperform, that's going to show you that investors really are quite overall concerned. It doesn't mean the market's going to have a big, huge correction. We're going to see a 20 or 30% correction. Well, we've already seen a 10% correction. But it doesn't mean that we're going to see the bottom of the market fall out. Now, that could happen, of course, but it doesn't mean that it's going to happen. But it typically doesn't indicate there's a large rallies ahead. And investors should be a little bit cautious at this time as far as their overall beta allocation in the marketplace. I think that's prudent within the context of what's happening here. And right now, we do see the favoring from a sector basis on the cyclical sectors in March. But once again, caution is probably advised within the beta. So beta allocation. So consumer discretionary has been beaten up here. Is that a buy just because it's a strong seasonal trend in the month of March? We might see that little the bounce take place because it has been beaten up, and we are in a stronger month for it as well. Materials, industrials tend to perform well. Sure, those sectors are probably favorable at this time on a slight basis, but we're still seeing and some of the strength in some of the other commodities, such as the energy sector as well here. We don't see a lot of hope, at least on a seasonal basis, for the growth sectors of the market other than the consumer discretionary sector. And once again, the caveat with that, it really is the Amazon and Tesla performance as well. So March is going to be an interesting month. At the beginning of the month, the first half of the month, it tends to be the stronger half. The Russia-Ukraine situation is a huge situation, and that's really going to affect everything. And like I said, too, if there was some sort of resolution or more ceasefire talks and things are looking progressive, we could see the market rally. But it's probably best within that 6-month favorable period for stocks right now to be a little bit cautious in the allocation as far as the beta allocation, the portfolio, as far as taking bigger bets with the market itself. But we still have some strong seasonal trends as a tailwind for at least some of the cyclical sectors in the marketplace. Thank you very much for joining me today.